So we're minutes away here from the Fed chair, the Q&A on Capitol Hill. Again, we're going to bring it to you live. Let's bring in our Steve Leisman and also former Federal Reserve Vice Chair Alan Blinder, who's now a professor at Princeton University. Just, Steve, in terms of the testimony so far, and anything else stand out to you?
Well, yeah, I actually want to answer Carl's question because Lou Breen wrote a piece this morning. Carl, the testimony, the Humphrey Hawkins testimony used to be way more significant than it is now. Lou Breen points out that back in 1999, it was a 5,500-word statement. Today, it's under 1,000. And the reason is all the transparency from the Fed. They're telling us in their statement, they're telling us in their speeches, in their interviews with us, where they're going, what they're doing. So this number comes in, you get a couple basis point movement in the bond market. Almost unchanged in the stock market, because most of what I'm seeing here has been expected. And the way I think about it is the Fed chair saying, you know what, I'm sleeping tonight, but I still got a gun under the pillow when it comes to inflation. This idea that we're attentive to the inflation risks here still. He says the risks are balanced. They're not really balanced, which is that the inflation numbers are in a place right now where they have to prove to the Fed they're coming down. The Fed is not taking this decline on faith. And so they've been using this phrase, we'll be cutting later this year. Almost every Fed official has provided the same guidance out there. So I'm not hearing much. And I think the Q&A is going to be very interesting, guys, as to whether or not there's the bias towards really worrying about inflation is really there.
Alan, how will they know when it's time to cut?
They won't know. That's the art of central banking. There's some science in there, but there's a lot of art, and especially when you get to subtle questions like that. Look, it's clear there's going to be some cutting this year. That's obvious to everyone, including everyone on the Fed. It would take something extraordinary to reverse that. But the exact timing, you know, it's about tone and feel and how much weight do you put on the latest data as opposed to last month's data and what you think next month's data are going to show. There's no pat answer. That's the bad news. I guess the bad news for traders. The good news for economists and for Fed officials, it doesn't really matter much whether it's 1 month earlier or 1 month later. The broad movement in interest rate is what really matters for the economy.
Are rates too high for the economy right now?
If you ask me, I want to emphasize this depends on subtleties and viewpoints and so on. If you ask me, I'd say a little too high. If it was up to me, which it's not, I'd be cutting now gingerly, not dropping rates dramatically, but I'd be cutting rates gingerly and cautiously. But other people have, you know, the other view.
Why? Where do you see it being too high?
Well, first of all, there are many lags. Now is going to be affecting the economy later. That's point one. Point two is the real rate is pretty high now. It's definitely in restrictive territory, as Powell and others have said. And thirdly, is the question of balance of risk. And Powell has said this umpteen times, including in his testimony today, and I'm sure he'll repeat it in the Q&A. You've got two-sided risks. You can wait too long to cut rates, and that might do damage to the economy, or you could cut them too soon, and that might do damage to inflation. And you've got to balance those. As I look at the numbers, I see just little signs here of the economy slowing, weakening. It's still very, very good. And I see more signs of inflation receding. Leave aside 1 month's data, and that's why I would come to the judgment I did. But someone else could easily come to the opposite judgment.